All right, good morning. Today is October 5th, 2022. And last week I wasn't able to do a show because we had a hurricane that was potentially bearing down on us. And fortunately, we got extremely lucky. um, we had like 2 days of a lot of wind, and I mean, it was windy. It was windy here before the hurricane even hit Southwest Florida. So I'm way up on the northeast coast, and so we had a lot of wind and not much rain, and it was no big deal. Fortunately, unfortunately, it was a huge big deal for a lot of other people. But so, anyways, I wasn't able to do the show because I was scrambling around my house sandbagging the garage and getting everything ready, bringing in all the furniture from outside on my deck, and because we had no idea how bad it was going to be here. The original path had it going from Tampa to Orlando to Jacksonville, and it ended up obviously coming in south and going out around the Space Coast and out to sea, and so it turned out to be not a big deal here, fortunately. But anyway, yeah, last Wednesday we were scrambling, yeah, because you just never know. You never know. So anyway, market's been pretty wild since then. Very wild, actually. So let me. Oh, first, I decided to pull this chart up again since it's so informative. A reminder that October 13th is when the next CPI number comes out, the inflation numbers. And that's going to be a big deal because, I mean, the market right now is trading based on what the perception of what the Fed is going to do. And sort of on a day-to-day basis, I mean, it's just crazy because, I mean, we're seeing these wild moves, the volatility. Yeah, I mean the volatility. Yeah, I mean the VIX. We could look at the VIX, but when I talk about volatility, I'm usually talking about the beta of the market itself, like the percentage moves of individual stocks and the market itself. But anyway, so the big number everybody's looking for is going to be the inflation rate, which a lot of people confuse inflation. When you talk about inflation, a lot of people confuse it with the rate of inflation, which depends on a lot of things. One of which is oil, which briefly dropped below $80 a barrel last week, and now, um, now it's back over 80. And there's a bunch of news about OPEC and all this stuff. So let's see, it's just under 85, which and of course everybody now is expecting it to go back to 100 because OPEC is cutting oil production or whatever. So anyhow, yeah, it's gonna be interesting to see what the inflation numbers are. In theory, in theory, they should probably. I don't know. I mean, that's going to be the. It's hard to imagine that the inflation rate can sustain at these kind of crazy numbers. I mean, these are end of the world numbers, and the funny thing is that our inflation rate's a lot lower than a lot of other countries. So, but that's the big thing. I guess this Friday the ADP payroll numbers are coming out, and that's another big deal. What everybody's looking forward to. So apparently, the the employment numbers are pretty good, and so what everybody's thinking is that there's no Fed meeting in October, so November and December are the two big things, and I believe that the conventional wisdom. I shouldn't say that. I should say the consensus. When I say conventional wisdom, it usually assumes that everybody thinks the same thing and they'll probably be wrong. But the consensus is that the Fed's going to hike. Well, it was that the Fed's going to hike 75 and then 50, and then wait and see what happens after that for the rest of the year. And so now there was a couple of central banks, if I'm not mistaken, kind of kicked off this rally to start the week. I believe it was the Central Bank of Australia was going to, had telegraphed they were going to raise 75 basis points, and they only raised 50, and so that was sort of a breath of fresh air. And there was another one too, but I mean, it's all water under the bridge. The big thing is what things look like in November for the Fed meeting, which is a long ways off, right? A lot can happen between now and then. As you probably know, everyone that had been calling for the lows are in was wrong, because the market actually on Friday closed at a new low for the year. So here's basically your year-to-date chart, and we've had this trend line for a long time. So I'll redraw it. There's the main overhead resistance, and there's a couple of things. One is when you sort of zoom in on this, this sell down that we just had here, and this basically, you remember a lot of times where I pointed out this 3-day sell-off here, and this 3-day sell-off happened on Fed hawkishness, right? Basically, if you go back and look at it. And of course, it's all tied together. Rising interest rates, as interest rates go up, the market tends to sell off, and as the dollar gets stronger, due to rising interest rates, the market tends to sell off and all that good stuff. So anyway, I like to look for patterns on the chart that kind of match up, I guess, analogs. I guess that's what you call them. I like to look for analogs on the chart, and I always have. And so, man, I got to tell you, these past couple of days prior to today, but Monday and Tuesday of this week, for one thing, it's the beginning of a month, and if I'm not mistaken, institutions tend to deploy funds at the beginning of the month, right? But man, I mean, we had this humongous 2-day rally percentage-wise, and especially a lot of stocks too, and my goodness, on CNBC, I mean, everybody's so excited about it and this and that, and I mean, records were set, and huge percentage moves and all this, and then you look at the chart, and it's a blip on the chart, honestly. So this little bottoming pattern. I mean, Monday was just kind of a snapback rally, first trading day of October. But yesterday's follow through kind of looks like, it kind of looks a little bit like this day in June here, right? Call it June 24th, where you had this, you had like sort of a little bottoming, and you came up, and then you had this kind of a breakaway gap, right? Like you had a gap and a huge up day there that just basically retraced into, some of the prior plunge, and you had sort of the same thing here. And so this, to me, and even back here, right, you had this sharp sell-off from here in early September. You had that 4-day run up there. These Fed speakers, which there's more of today, I can't even believe that the Fed has sort of pursued this strategy of all these Fed speakers speaking at all these different things, and and sending mixed messages and talking about this and that, and it's almost ridiculous, because, well, it is ridiculous. But anyway, most of them are sticking to the idea. The market doesn't seem to want to believe that the Fed is going to stick to their strategy of raising rates and holding them higher to stave off inflation. So everyone's thinking that, well, maybe the Fed won't be as aggressive, and yet they keep saying that they will. And so, I guess just about as long as I can remember, and most of the participants, the Fed, they say they talk tough, and when push comes to shove, they acquiesce. And this all, this happened back in 2018. There's been a few times here, I think, that I've mentioned that this year kind of reminds me of 2018, which was not a good year for stocks, by the way. In 2018, it started off with like one of the best Januaries in years, and then by the end of the year, the Fed thought that they were going to be able to hike rates, and I think they hiked a few times or whatever, and then the market like sold off huge, big time into the end of the year. I mean, it was tanking. I could pull up the weekly chart and show you, but 2018, the market was tanking in December, and I think it was like Christmas Eve or something. Hit the lows, and so it was down like 6% for the year. Now, the S&P was this year was down like what, like 23%, 25% roughly, 24, 25% there. Of course it depends if you pull up a weekly chart or a monthly chart or whatever you get. Actually, this month kind of worked out for looking at the longer term charts because we actually hit the low at the end of the month. But a lot of times, if you pull it, well, not a lot of times, but if you pull up a monthly line chart, it's not going to show the intraday lows, right? And so a lot of these line charts, well, all the line charts don't show the intraday price movements. They're based on the closing prices, and so you get a whole different picture, right? If I turn this into a line chart, that trend line is not even gonna, that trend line's not really gonna match up the same. So anyway, lot going on. I mean, the volatility is just crazy. Yeah, so I do this a lot. I mean, I look at like the weekly charts, and so you can see on the weekly chart, it's obviously not taking into account the intra week highs and lows, quite frankly. So, but these line charts, I do like to look at them on daily, weekly, and monthly basis because you see this big sell-off, and then you see the past couple of days here, or actually this would be like this week so far, right? And then you look back and you see kind of what I was looking at before, a lot of very similar type of patterns, and I mean this looks similar to that last little 4-day rebound that we had here that failed. Um, It's possible that we get something similar to. I mean, there's like sort of three big humps here, trend lines up here. It's possible that we get some sort of something similar to. Whoops. Go back to my normal chart here. Similar to what we saw over here, where we had a big sell-off and then we had sort of a snapback rally, a higher low, floundered around and went up and rallied, right? That's entirely possible. Entirely possible that that there's another rally in the cards. Whoops, that I didn't mean to do. All right, so let me see if I can. Here we go. Yeah, these charts can be a little difficult to work with sometimes. There's what I wanted to do. I wanted to get this chart so that it's not that easy to do, but it's doable, right? So there we go. I wanted to get the whole year on here, right? So you can look right here. Here's 2023, not that far away, and so just suppose that the market was able to stage a rally. I want to extend this line all the way out to the end of the year. There we go. Yeah, there's no easy way to. There we go. There's no easy way to just go back that I know of. But anyway, so it's indeed possible. See, the big thing yesterday on CNBC, after this 2-day rally that was, it was like they, I swear, all day long, especially with yesterday's follow through, it seems like, the financial media was just jumping up and down, acting like the market was, going to be back at the all-time highs in a couple of days. They got so excited about this, and And so they started asking everybody, is the low for the year in? Is the low for the year in? Is the low for the year? Everybody, have we seen the lows? And quite frankly, I mean, they started that back in, probably back here in January, and then in March, and then in May, and June, are the lows in. And I do remember, you guys remember this? Like back over here in mid-August, there was there was all this discussion about the fact that since World War II, there had never been a bear market that retraced 50% of its down move and then gone on to make another low, right? And so that was a statistic they kept throwing out there, and then sure enough, it went on and it did make a new low. So, and I believe it retraced 50% or came close to it. But the funny thing about that is that the caveat there is since World War II, because it actually, I'm pretty sure that back in like the 30s or whatever, there was a bear market and it did have an up move and then went on to make a lower low in like 1931 or 32 or whatever. But anyway, all that doesn't matter. Right now we got this low, and quite frankly, I mean, you start getting nervous, right? I was getting nervous last week because I remember 2008 very well. And when when the news cycle started getting scary, it kept getting scarier and scarier and worse, and man, you woke up and you wondered if the financial system was gonna still be intact or something happened overnight. So I mean, bear markets are no fun for sure, and they usually end with a bang and not a whimper. So interestingly enough, this morning I was watching CNBC and I saw Sam Stovall, right, who over the years, I mean, not only has he made a lot of accurate predictions over the years, but he's almost always been bullish no matter what. And he's one of those guys that's been around forever, right? Sam Stovall. I mean, everybody knows. And quite frankly, I was shocked at what he said, and he said that he thought the S&P was going to 3,200. And it's kind of interesting because based on if you take I'm not going to attempt to do it right here, but if you take and draw a Fibonacci from the dead low of the pandemic low, you draw a fib all the way up here. This low right here that we're at now, well, maybe I should do it just for the. Here we go. Thing about the Fibonacci is that, well, hang on, let me get this up here because I think it probably is worth looking at just for the fun of it. So here we go. And the funny thing is, this is basically what he was looking at. All right, so let me see here. How do I fix this? Fibonacci. Well, I got it drawn on there. I guess that's good. Oh, here we go. No fill. There. That makes it a little cleaner. So, whoops. All right. Bear with me because I'm trying to do all this stuff live here. But so this is what's interesting and why I thought what Sam Stovall had to say was interesting, because he was talking about the fib, and so we've almost come down and retraced half of the pandemic move. And don't lose sight of the fact, right? Like, don't forget that this move from the pandemic low up to the the high around 4,800 was primarily based on the Fed, unloading both barrels of money. The Fed and the government, they just went nuts as far as stimulus, right? Fed stimulus, QE, and balance sheet expansion, and they back over here, man. They dropped emergency rate cut, dropped rates to zero, and threw hundreds of billions of dollars on the same day. $100 billion and cut rates to zero to because the market collapsed 35% in a few weeks here, right? And so and they were appearing on 60 Minutes and stuff. I mean, they freaked out, and maybe with good cause or whatever. But see, here's the thing: you keep hearing about policy mistake. The policy mistake it happened in. I'm gonna say the policy mistake sort of started here. Just on April Fool's Day of 2021 is when they should have started cutting back on everything and said, okay, we're going to get through this and that. We can't hold rates here at zero or it's going to be inflationary. And so, go back to that inflation chart. This is when inflation started picking up was, around the beginning of 2021. And obviously, they made sort of a policy mistake, and now they've raised interest rates. Like, this is one of the quickest rate hiking cycles in history, and everyone's freaking out because they're worried things are going to start to break, and there's a lot of places where things, theoretically are already breaking. But all that aside, going back to what I was saying before, Sam Stovall said that, the typical bear market loses about 35% and runs about 15 months, right? So here we are, roughly. Well, I guess you could say we're 9 months into the bear market, and that's the other thing too. I've seen some stats out there that say, that the bear market started on January 5th at the high. This is where the bear market started, and that doesn't make sense to me because it wasn't a bear market, when the market was only down 5% or even 10%. It was a correction, it wasn't a bear market, here in April up, at these highs. So to me, the bear market didn't start, until back over here when the market had finally pulled back 20%. So I mean, it's a question of semantics, but it was not a bear market until the market was down 20%. That would have been, when it was officially a bear market. And so you can't go back and say the bear market started in January. You can say the high was in January and we hit, bear market territory in May. But so anyway, that's interesting because what Sam Stovall was saying about the typical bear market lasting 15 months. I'm not sure if he was assuming we're 9 months into it or assuming it started in May, in which case, June, July, August, we're only 5 months into the bear market. So anyway, what I thought was most interesting, I keep diverging from my original point, is that his 35% off the highs, he said 3,200 roughly correlates to, roughly, he believes that 3,200. And of course, there we go. Let me fix this chart here. There we go. Okay, that's what I was looking for. So literally, Sam Stovall's idea is that, the average bear market loses 35%, which would put us at about 3,200, which coincidentally is almost exactly, the 61.8% retracement of that move. So that I thought was fascinating. That was the most fascinating thing of the day. And you can look at this chart and, this really puts like the past couple days in perspective. I mean, we've seen, all throughout the year, we've seen these tremendous rallies off of new lows and oversold conditions. Can't see it on the chart, so let me see if I can pull this up here so you can see it. And here's another thing to look at is, go zoom in a little bit here. Yeah, you can see that. You can see how the RSI. This is obviously this is a daily S&P chart. You can see how this RSI got buried back here below 30, and there was actually there was a positive divergence, right? A little bit of a, well, yeah, there was. I mean, it was a positive divergence. The market made a new low at the end of September, and there was a slightly higher low in the RSI. It just barely poked below 30. So I mean, for what it's worth, right? I mean, for what it's worth, you know, that happened. And so I don't, at the end of the month when the market was tanking, I don't remember a whole lot of people that were saying, "Hey, this is it. This is the panic capitulation low and this and that." And so um, what I was reading is that Credit Suisse is in trouble, and there's all kinds of things that could break and that. And so um, yeah, I mean, it's really really hard to know what happens from here. I'd be surprised unless something like really crazy happens. And see, there's a lot of geopolitical tensions out there. I was watching the futures the other night, and I'd had dinner or something like that, and I was fooling around. I came in here, and I had the futures open on my screen, and then I read some breaking news about North Korea shooting off a missile that went over Japan, and I looked over the futures, and they hadn't even budged. And I remember years back, a news headline like that would have sent the futures cascading lower, and now it's like nobody cared. So that was interesting. But my point is that there's a lot of geopolitical stuff happening out there that y'all know of, and these crazy rising interest rates and mortgage rates have doubled, and I mean just on and on and on. The macro environment is horrible. And so, anything could happen. And this whole thing about the Fed pivot is kind of ironic, because the theory behind that is that the economy is gonna, be on the brink of recession, and even that, like half the people, there's half the people say we're in a recession right now, right? We did have two negative quarters, two negative GDP growth quarters in a row, which typically constitutes a recession. And so anyway, everybody's debating whether we're in a recession now, whether we're headed to a recession. I read an article this morning that said the and I forget who it was, but one of these talking heads said that he doesn't see a recession until the second half of 2023. I was thinking to myself, well, geez, and he was saying to buy the market now, buy, because he doesn't see a recession until next year or something. So I don't know. There's a lot of spin and a lot of ridiculous stuff. But anyway, the point that I was originally making is that the macro picture is really sort of cloudy, I guess you could say, just very uncertain. There's lots of things that could happen. There's lots of, there was talk last weekend of, about crazy stuff going on over in Russia and Ukraine and all that. So there's just so much stuff. And of course, winter is coming to Europe, and so they're going to be in a recession. And so, I think to myself, all these problems everywhere, globally, China, Europe, Russia, Ukraine. I think to myself, how is the United States just going to go on its merry little way, if all these other countries are having recessions or worse? And so my point is that the macro picture is just really bad. It's been a terrible year. I mean, every little pot shot attempt that we've taken, which have been extremely minimal, it has not been a good swing trading environment at all. I mean, there's really been two opportunities so this entire year There's been two opportunities for taking swing trades, that would have worked out, and this was one back here in March. And then, sometime here in like June or July, catching that move right there. But that was about it, really. Other than that, so, there's been some individual stocks that have done really well and had huge rallies. And then you get, something like yesterday where you get these crazy, like sort of 1 day rallies. But the volatility is just nuts. So, all right, real quick. I mean, there's not a whole lot to say here because wanted to look at ARK just to get some perspective on. This is my go-to chart, as you know, on. I guess you could call it like risk on or momentum. How are momentum stocks doing? How are the promising new technology stocks of the future doing, that type of thing. So, ARK was up percentage wise, it was up huge the past couple of days, right? But you go back and look at this chart, and I mean it's just blipping around here, trying to in a range, quite honestly. And so this is a really good one to keep an eye on, just because, and like they're obviously Tesla, you know Tesla's a bit is a it's a controversial stock, but Kathy Wood was on CNBC yesterday. She bought a whole bunch more Tesla, which by the way is down 5% today. I mean the moves on some of these things, the daily moves, ought to make you nervous. This reminds me a lot of, it reminds me of sort of like the area around the dot-com bust, right? We saw this type of price action way back then. Tesla, Zoom, and Roku are like, if I'm not mistaken, are amongst her largest holdings. And yeah, they put out that research paper on this Zoom video that said that they expect it to go to 1,500 in 5 years, and so that'd be something, wouldn't it? But count me as being a little bit skeptical on that. I mean, 1,500 in 5 years. So anyway, I like to watch ARK. I like to watch Zoom. Roku, I don't quite. And I mean, some of these things. If you were around during the dot-com days like I was, I mean, that's when I was kind of just getting interested in the market. Um, there was plenty of stocks like this, quite frankly, and they never recovered. Never, ever, ever, ever recovered their losses. And I expect that this time around. I mean, there's tons and tons of stocks out there that, I mean, this right here is like an extraordinary, I mean, this is a jaw-dropping decline. And I'd be surprised if this thing ever went, from the 50s back towards 500. What happens with these companies is, or what happened with a lot of them back in the dot-com days, they change their names, or they get bought by private equity, or they merge with another company and change their name, or or somebody like Roku, somebody like Microsoft or Google or Apple, could buy them because theoretically they're viable. I mean, I have a Roku box, and there's Roku TVs and this and that. So I mean, there's a lot of viable businesses whose stock price has just been utterly destroyed. There's Zillow. And so, these kind of companies, what happens is the stock never goes back to the original high. And then, years from now, they were either bought out or changed their name or merged with somebody else, or, something like that. This is what typically happens. And so I think, a lot of especially novice investors got sold stories on the market and sold stories on these kind of crazy stocks. I remember there's so many of them. Just I was trying to think. I was looking at some IPOs the other day. There's this is not even it, but I remember when this one went public. Bumble, right? Something called Bumble, but a lot of these software type stocks and that this thing was $80 and now it's 20, and it's like it's a dating app. Is basically what it is. Um, software, software companies. Yeah, this is a typical, and see, here's, the one sort of bright spot that I can think of is comparing, comparing now to the 1999 2000 .com implosion, is that a lot of these stocks have already, they've already imploded. They've already had their .com implosion. It's just that, the S&P and the Dow haven't had their .com implosion, but individual stocks have. I mean, here's a stock that went from 50 to 400 and back to 50. Right? And so, and I mean, on the way up, geez, this was one of those IBD 50 stocks on the way up, just really high earnings. And this might have been, at some point, might have been like number one on the IBD list or whatever. Earnings momentum, growth momentum, sales momentum, all that stuff, right? And so, to me, a lot of what happened was that stocks just got crazy overvalued to begin with. Like, they never should have been. You can go back to the S&P here. I wanted to see if my fibs were on the chart. In theory, the market should have never gone that high, and so maybe it's just returning to what makes more sense. There was kind of a mania, right? It was kind of a mania happening, and so I saw it every day, right? And the whole thing, the meme stocks, right? So what were the meme stocks? GME, some of this stuff, like, it should have just never happened to begin with. And so, you got I don't even know where this thing started, but 25 to, almost 125. And so GME, and you look at these charts, and so, maybe this should have never gone from 5 to 45, right? And so that's what I think of when I look at a lot of these software stocks and technology stocks. It just went absolutely crazy. So anyway, right now, with the market being so big down cycle, little bit of a rebound, we're giving some back. This is actually probably a decent tradable low. And we've come way far off of this low. Ideally, the market will fill this gap, bounce around, and do something, and not make a lower low. And quite frankly, I mean, I have no idea what to expect, but I would say that trading the market on the next, on a pullback that doesn't exceed this low. I mean, if the market drops below 3,600, then look out, right? Like, if it's headed to 3,200, like Sam Stovall thinks it is, and nothing happens fast either, right? It's a day-to-day thing, but there's a decent tradable low there. So that's all I'll say. There's a tradable low there. If we get some backing and filling, see what the rest of the week looks like, then there's some potential. There's some potential that we may actually be able to take some attempts at some swing trades and get something like what we saw over here. We get big rally, a little bit of some retrenching in that, and then potentially a move, higher, right? At least a relief rally. So we'll just have to see. Anyway, I'm getting some sort of message from YouTube that I'm not receiving enough video or something here, so I'm not quite sure if I'm still recording or online. So with that said, I'm going to end it, and I will see you back here next week.